name is Eric Hartley.
And Phoenix Talent.
We're going to be presenting Canopy Growth Corporation to you. So Canopy Growth is an international producer and distributor of medical and recreational marijuana in the jurisdictions where marijuana is legal. They have three primary products. We have our soft gel capsules, which are a medicinal alternative to edibles. They can function as a CBD or THC vessel. We'll get to that in a second. We have dry or raw flower, which is the most common form of cannabis. And then we have extracts and oils, which can be comprised of THC, which is the psychoactive chemical in marijuana. Basically what gives users a chemical high. And CBD is cannabidiol. It's a medicinal use chemical that can be used to treat anything from anxiety to chronic pain. And then hemp is a genetically different type of cannabis plant that can be bred for industrial purposes. They call it industrial hemp, and it can be used in everything from clothing to biofuel, and it has almost no psychoactive properties. Before we get too deep into this, what is marijuana? Well, it's not hemp. Hemp is something completely different, which is now legal in the US, coincidentally enough. There's two types of marijuana that we can breed, which are going to be sativa and indica. Sativa is uplifting, fuels energy, and fuels your appetite. And indica is relaxing, can be used for pain reduction, and helps people fall asleep. We can crossbreed the two types of plants to create a indica sativa hybrid, and we can try to select the specific effects that we're looking for. And then our CBD and THC levels can be affected by which plant we choose and how we actually grow the plant itself. Speaking of growing the plant, it starts out as a seed like most plants do. It goes into a seeding state, at which point it becomes vegetative, and we can substitute this state with a clone from a mother plant, so we get a genetically identical plant to a full-grown one that has the specific properties that we want. At which point it will start to flower, we can harvest it, and then we go on to dry and cure it. Some of the legal terms that are significant, one that's not in here is the States Act, which we'll get to a little bit later, but the US Farm Bill, which is revised every 5 years, this most recent iteration included industrial hemp and removed it as a scheduled illegal drug, and so it can be grown and cultivated, and that is Canopy's first introduction to the United States. They're going to be growing hemp in New York. The Safe Banking Act, if this act goes through, it would allow U.S. marijuana corporations to safely bank with financial institutions here in the U.S. without federal repercussions. A little bit of history on Canopy. They started in 2014 as a medicinal supplier in Canada, and they went public in May 24th of 2018, and shortly after were invested in by Constellation Brands, which makes Corona and Modelo. That was a $5 billion investment. Shortly after, had to destroy some of their major crops due to licensing problems. They could not obtain proper permits to move product before legalization happened on October 17th. And since it was legalized on October 17th of 2018 in Canada, there's been a short supply forward in the country. And hemp was just legalized this year. Looking forward, we're looking at edibles and beverages legal in Canada.
So here we are pitching a buy today. At the time that we did this, the current price was $40.73. It's since shot up to $47.71, which we will talk about why that is later. Here we can see Canopy Growth is in the orangish yellow color. The S&P 500 is in the red, and then we put in Aurora, which is Canopy Growth's largest competitor, in blue, just to see how those two stocks look together. You can see that the Canopy Growth does not follow the S&P 500, and it has stayed significantly above for the most part, except for right here, unlike Aurora, which is been all over the place as opposed to S&P. But looking at those two stocks together, they are very, they do match each other very well. So why are we going to buy Canopy Growth? Well, for one, they have a very healthy growing balance sheet. They are continually doing major acquisitions and partnerships with other cannabis companies around the world, which is spreading their roots to all over places in the world that has cannabis legalized. So here you can see that their revenue has consistently gone up over the years, but consequently their operating margin has decreased by quite a lot due to they have a very aggressive growth strategy where a lot of their operating expenses are continuing to grow with the more and more acquisitions they're making. And because of this, they don't have a positive net income, and they probably won't have a positive net income for the next years coming because of their growth strategy. But because of that, we get a negative earnings per share. Their price to sales we felt was a better representation of how the business is doing because it accounts for all of the revenue that they are getting every year. Their price to book has stayed pretty constant over the years, and then their enterprise value, due to their very large cash position, and they don't have a lot of debt, which we'll get into, shows that they have their value to the market has increased quite significantly. Right here is just kind of a breakdown of their revenue. You can see that between the two, we now have a recreational section, which is due to the legalization, which medical use of Canada obviously decreased quite significantly with that new section because of the legalization. Other revenue is mainly consisted of things like deferred revenue, accounts receivable, things of that nature, and then medical is broken down into just in Canada and then internationally. Profit and loss, here again, just the revenue has continued to go up. Their gross margin, because of the stock production in like late 2018, because Canada ran out of weed, their trailing 12 months shows a negative gross margin, but that doesn't account for the recovery that's happened because of it. Their income statement does not look pretty at all, like I said, but that's mainly due to their aggressive growth strategy, and it'll continue to look like this, but we don't feel like that's anything to worry about because they're on the up and up. Operating margin is mainly just due to their acquisitions that they've done over the years. And then this is just a clip I took from their 10K that just shows exactly what all is included in their operating expenses. Things like paying employees, raw materials, other expenses, marketing, things like that. For their balance sheet, you can see right here is the investment that they collected from Constellation. Their current liabilities is basically just their current portion of their long-term debt, which is mainly just all of their mortgage from all of the facilities that they own. Current ratio, because of their cash is continually going up and their assets are going up, they have more than enough to pay off any liabilities if they were to go bankrupt. Long-term debt, like I said, is basically just their mortgage for all of the properties that they own, and over the next 5 years, their long-term debt payments just continue to go down. Or the payments that are coming due to current liabilities, they're just gonna continue to go down. And then for inventory turnover, right here we see we have negative inventory turnover, which normally means that they are selling more than they have. But in this case, what I found out was that their biological assets is what they call like their seeds and their plants and their marijuana. And they have to decrease it to the net realized value of their product before, and then that gets expensed out of their inventory, which makes it seem like they have less inventory when they don't. They're just decreasing the value of the seeds to what it actually is.
And as Phoenix was saying, they have a very expensive growth strategy. You can see that they operate in almost all of the legal markets in the world that allow for sale and growing of cannabis. A green circle indicates a grow operation, a blue circle indicates a joint venture grow, and a gray circle indicates a grow construction. And then the green diamonds are medical distribution centers only, and a gray diamond is a medical distribution expenditure. Storz & Bickel is the only partnership in the world that has the exclusive rights to sell medical vaporizers for administration of medicinal cannabis in the world. They're the only ones that meet the regulations, and this is a strategic partner for Canopy growth. I'd like to point out that this map does not include expansions to existing facilities, and since there has been a shortage in Canada since its legalization, they are expanding some of the existing facilities as they build the new ones up. And it also does not include retail support for each individual grow operation. Usually what happens is we build a grow and then we build supporting retail in the surrounding areas in the form of dispensaries to sell our product.
So do they distribute in the same countries where they grow? Is that what you were?
Typically, it depends on the country in question. Like in South America, it's not legal recreationally everywhere, and so you see there's a lot of medical distribution centers, so I don't know if
Yeah, which of those symbols relates to recreational? I don't see that in the key.
That is in a different slide. Recreationally, it's only legal in Canada, and then I believe Jamaica and some of the South American countries.
What's Batel?
Batel is a research joint venture in the U.S., so they're actually, they have licensing to ship product to Batel, and then Batel will run tests and analysis on it to see the different chemical properties, quality, and they basically doing research on medical marijuana.
But they don't currently distribute in the US.
Is that the national laboratory run by the government? Or is that a private company that's just somewhere now?
I'd have to look it up again. I don't believe so, but it might be. And just to give you an idea of what the retail scheme is, this is just lifted from their investors presentation. This is kind of how they support their growth facilities. You can see where they are. They sell in different territories. They do sell to the government where they want to sell medical marijuana, so they don't actually have to set up any sort of brick and mortar stores to sell their own product.
So for their competitors, we chose Aurora, which is another Canadian weed producer. It is the second largest, and it does have a partnership with Danis, which is Germany's largest distributor of cannabis to pharmacies. Tilray, which is another Canadian pharmaceutical and weed producer. They are the interesting fact, they were the first to be on the NASDAQ, we were the first publicly traded Canopy company. And they have as of December 2018, they partnered with Anheuser-Busch. Hexo, another weed producer in Canada, they which is Molson Coors. Or they're partnered with Molson Coors to develop cannabis-infused beverages. Cronos is a cannabis research, technology, and development company, and they just recently had a $2.4 billion investment with Altria. Aphria is a medical weed producer and retailer, and they were supposed to have an $89 million investment with Green Growth, but it was terminated. And then MedMen, which is a manufacturer and retail of cannabis in the U.S., and they have stores in New York, California, Nevada, and Florida. And then here we can see that Canopy, they do have the largest market cap out of all of its competitors. They do also have the largest inventory turnover. In comparison to like Aurora, Tilroy, and Cronos, which are probably the three largest out of this, their EPS, price to book, debt to earnings, except for Tilray, which is quite large. It's all pretty consistent, so they're all fairly comparable to each other. MedMen we wanted to include just in case. We wanted to compare it to them in the hopes that one day, when cannabis does get legalized in the U.S., we can see how this company is doing and how well Canopy can do compared to that.
So part of how Canopy provides value to its customers is with individual plants. They have begun filing patents. They have 140 filed, 32 currently held. Most of these are not public. It's something that Canopy talks about in their investor pitch, but due to the blackout period associated with patents, we can't actually see them for about 18 months, and that's the same with their competitors. However, their competitors don't list patents as a major part of their strategy in their investor pitches. Part of how we create value for customers is by crossbreeding plants and developing different types of marijuana and marijuana products. And Canopy does this not only through organic and purchasing growth strategies, but they also partner with companies like DNA Genetics and their biggest partner to date, which is Constellation Brands. Canopy has the best buds in the business. Constellation is the #3 beer producer in the world. It was a $5 billion investment, and in exchange for 37% of Canopy's stock. Constellation has 100 brands, over 100 brands in its portfolio, and offers a strategic parallel to Canopy. Contacts, equipment, and most importantly, supply chain resources that they can utilize across the globe. When we're moving into these markets and using our aggressive growth strategy, Canopy is kind of using its Canadian model as a basis for how they get into markets, usually starting with medicinal cannabis and then moving into the retail space, which they do better than any other Canadian company. They control 30% of the Canadian recreational market. CBD as a global market is expected to be $22 billion by 2022. And when Canopy entered into the U.S. selling industrial hemp, they provided a gateway into the U.S., and they also have another one, which we'll get to in just a couple of slides.
So for our evaluation, we came up with a target price of $52.07. We did that through weighting their DDM at 0% because they do not pay dividends. FCFE we did at 20% just because we felt that the relative valuation we came up with their price to sell was more accurate because it included all of their revenue and their continued growth revenue over the years to come, which got us the total of $52.07, which just again to point out, we did this when it was $40.73 and it's now like $47.
We're using all the comps that you have listed here in that price to sales, because it looks like, aside from one, Kronos, that seems to pull all the comps up quite a bit, because they have a very inflated price to sales ratio. Canopy's the second highest. So if you were to take out that one outlier, you would have a significantly lower valuation. You have one, basically Kronos is trading around the 60 times price to sales, everyone else is trading like single digits.
So you're saying if I were to take that out, it would be significantly lower?
Yeah, the valuation you would have gotten would be a much lower price.
So here's a map of the legal markets and where they are in the process of legalizing cannabis. Some risks to the Canopy investment would be legal restrictions. As I mentioned before, they had to destroy a crop due to being unable to secure proper licensing to move product. Sizable partnerships between competitors. Aurora Cannabis was in talks with Coca-Cola about developing a CBD-infused beverage. That deal never went through, and Coca-Cola has come out and said that they're just watching the industry from the sidelines at the moment. Sizable crop failure is always a risk when we're dealing with an agriculture stock, which marijuana is, although they treat this more of a science than a farm. It's all done in a laboratory under very stringent conditions. They're very particular about what goes in and what goes out, and so the risk of contamination is rather low. Some additional catalysts for this investment would be the second wave of legalization in Canada, which is edibles and beverages, which are not currently permitted in the country, and potential legalization in the US, of course, and then beverages regarding CBD. Some US companies are currently trying to take this on, and Constellation is watching from the sidelines. Canopy doesn't want to get involved in the US until it is officially legal here. But they did, however, as of yesterday, agree to buy Acreage Holdings, which is a US-based marijuana company that operates in 20 states, has 22 cultivation and processing sites, 20 state licenses, 87 dispensaries, and is one of the major producers in the United States. This is a contingent offer. It's $300 million up front, with penalties if Acreage were to cancel, and it is all contingent on legalization in the next 7 years, at which point it would be a $3.4 billion acquisition.
How much cash does Canopy have sitting on their balance sheet right now? Are they financing this in cash, or?
They're financing it partially in cash and then through stock distribution.
4.1 billion right
The States Act was just reintroduced as of this year as well. This was an act that was introduced previously and was shut down, and this would leave legalization up to the states. So basically what it is right now, but it would be federally permissible, and it would open the U.S. market up to Canadian firms, which would allow the deal to go through, and then Canopy would be able to allocate their resources to Acreage and utilize their supply chain and really bump up Acreage's numbers, which are already quite a bit higher than some of the other companies operating in the U.S.
And then also last Thursday, before we gave our before we were getting ready to give our presentation, they also acquired Cafina, which is a producer to cultivate, distribute, and export medical marijuana in Spain. So it increases their European footprint, and it also increased the stock at that time. Yes.
On the balance sheet, it says on your trailing 12 months, your numbers jump up
Right,
substantially. Like,
that's due to the Constellation investment.
that's like
5 billion.
10, yeah, $5 million jump.
Billion.
Billion.
Yeah, that's how much the investment is.
And, I mean, everything jumps up, I guess.
Could you explain this debacle in Canada? You mentioned them running out of food or something, like, explain this whole situation to me, like why all their trailing 12 months numbers are going up or something that happened.
Yeah, in October, I believe,
When it was.
or November, right when it got legalized in Canada, Canada ran out of weed. Like, everyone ran out of weed. There wasn't enough supply to meet the demand that all of the consumers wanted.
In the first 2 days, it was pretty much like sold out at all the dispensaries because they were being kind of modest with how they wanted to approach the recreational market, and they ran out. And then all of the suppliers in Canada haven't been able to produce enough product fast enough to meet the demand. And there are projections that they will oversupply, and that's where companies of this scale will benefit because they can export to other countries and sell those on the medicinal market.
Where do they currently export? So you showed a map of their facilities. Given that this is just still regulatorily a highly controlled substance in a lot of countries, where have they been able to actually export?
Basically, all of Europe. They have one grow operation in Spain, I believe it was, and then everywhere else is they're importing marijuana, exporting and importing. But one of the things they like to brag about on their statements are that they were able to get into the German market, which is one of the most tightly regulated markets in the world.
Where are they concentrating their efforts in terms of, you talk about their aggressive growth strategy. From what you guys have presented, it sounds like they spend a lot on R&D and actually cultivating and creating product. Do they distribute their own product? How are they getting into market? And yeah, so those are actually two separate questions. So do they distribute their own product?
Yes, I think that they also sell to other dispensaries, but they have, originally they started as Tweed and then became Canopy Growth. So Tweed is one of their subsidiaries, and if we go back to this slide, Haiku Metrum and Bedrockin have a slew of other subsidiaries in which they sell marijuana through at different branded dispensaries like Tokyo Smoke, and they use these as distribution points. So when I was talking about the grow operations having dispensaries to support them, that's kind of what I meant by they take one of these license names, and that's some of their patent allocation will be on these, and they will distribute through those.
Okay, so then almost like a franchise model? They're not running these dispensaries, or are they wholly owned?
They're wholly owned.
Okay. So these guys do everything from cultivating seeds and developing new strains to creating product to distributing it at their own branded retail.
Yeah.
And then they also have partnerships.
Yeah.
Where are they investing all that money that Constellation gave them? What's their growth strategy more specifically?
Well, the golden egg is obviously the U.S. market, so they invested into the hemp industry to get their foot in the door, and I think that actually opened up because I think the owners are from New York and have offices there, and I think that's what kind of opened up the door to that partnership. I know that they spend a lot of money in other countries to help the facilitation of legalization, and then they also, when you're just exporting, it's much more expensive, especially at these medical distribution sites.
What's the benefit of scale in this industry?
Well, the larger the grow operation, or the more grow operations, the more product I have to sell, And most of the major companies have scale, and they're trying to aggressively get into other countries, and that seems to be the industry trend for the major companies.
So why do you like Canopy better than Aurora or Tilray?
Tilray has had their ups and downs. Aurora is closely competing with Canopy. However, they're going to be a little bit late to the game in terms of beverages, and we're kind of banking on that as being a major industry, as indicated by the CBD market. A lot of the other competitors have been reacting to Canopy's strategy. Canopy was the first to partner with a major company, and then Hexo was promptly bought by was it Coors? So Coors was reacting in response to what Canopy was doing with Constellation, and Canopy still has a majority in that.
Are you concerned about the volatility of the stock?
Yeah, I mean, it's always a concern, especially when we're talking about a fund like ours. We focus on diversification, and then we want that money to grow. We don't want to see anything rise and drop rapidly. But with this pitch, we were looking for the best company in this industry, one that would have major staying power. And I think that Canopy is the best positioned out of all of their competitors to do that. And I did a lot of competitive analysis for this one to make sure that the competitors were nowhere close. And it varies from company to company what their shortfalls are, but whether it's not operating in some major industries or not being able to secure enough funding or leverage, acting in response to Canopy's strategy and coming late to the game, or just having issues like Afria is another close competitor, but they have some questionable purchases down in South America, and their stock price has been even more volatile.
Questions from class?
Ben's dying over there.
So, this might be a dumb question, I'm not sure. But
There's no dumb question.
given the fact that it says here that 70% of, it says at least the majority of your money comes from recreational market, and somewhere around like 30% comes from medicinal. And so why is it considered a healthcare company and not like a consumer discretionary? And if this is something that people are going to buy, whether the market is high or low, consumer staples.
Well, that's actually something me and Eric argued a lot about, was what sector this went into. And it would be healthcare, considering it just became legalized. So they just, like in the revenue breakdown, like they just got a section of their recreational revenue. But we do think that like as time goes on, it would begin to separate. So
Yeah.
medical marijuana would stay in healthcare, and then like consumer discretionary would get its own.
Right, and if they, like other places are legal, and especially in Canada, and I assume Canada is where they get most of their recreational revenue from, like just because it just became legal in a few states in America, like my point is that I think it should be probably considered more towards one of those companies, because most people when they think of marijuana wouldn't think of medical.
So this is a question of classification, and if it was classed as a healthcare stock, seeing that like that big jump in recreational, their revenue, it's likely to be reclassed as consumer or staple, consumer discretionary, whatever.
Mm-hmm.
Probably consumer staple, because all the tobacco is in consumer staple, and I'd imagine it would be treated like that. And the technical, like when the indices tend to reclass companies like that is usually when like the majority of their revenue, but there's a specific threshold. It might just be majority, but when it comes from that category that has moved over. So you'd likely see the next time the indices are updated, that it would be moved into a different sector. So I would, in my head, treat it like a consumer staple company.
Gotcha.
All right. Kim, how much time do I have?
One question at a time,
All right.
let them answer, and then I'll tell you to stop when.
We'll start easy. The first page, your beta is showing 1.15. Amazon right now is at 1.71. Are you telling me that Amazon is more volatile than a weed company? Because I am fairly sure last time I looked at it was above 4, the beta.
For marijuana,
No, CGC.
CGC.
Because if you compare your beta with the market segment beta, of course it will be low, but at the same time it's still up the roof. So when you look at the beta, if you take the whole S&P 500 and you compare it, or if you compare it with the whole market itself, it will be at 4 at least. So I'm just wondering where you got that, because
I got it off the paper.
do you have it like a daily beta or monthly one? Because this one is
It all goes 2 years.
well, 2 years that wouldn't work either, because that company went on Toronto Stock Exchange in 2018.
So,
It just takes the
We're
last few
pulling
months.
from the New York Stock Exchange, which is where.
So the new beta, because they just do a list.
Yeah.
Okay.
believe so.
Well, 1.5 is 1.15 is
so it's a valid point, and like I pull up Yahoo Finance right now, and the 3-year monthly beta, which I'm actually not sure what Yahoo uses as the index for that one, is close to 4, it's 3.99. I generally go with Bloomberg over Yahoo, but it's good to remark what time period you're looking at and what index it's progressing against. But I mean, you can just look at the chart. Remember, JP beta only reflects movement that's correlated with the market. So this might have a lot of idiosyncratic movement because of the
well, I think it's the
maturation of the.
yeah, I think